How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic I'm very excited to speak about. It's what is an IUL? And what is an IUL contract? What is an IUL policy? And essentially, how can you leverage this to be extremely advantageous for retirement planning, for investment type planning, for safe, consistent growth with a tax-free outcome on the back end. So let me just go into the basics of the policy, the basics of a permanent life insurance policy, and then dissect, okay, why exactly should you be interested in the IUL? And on top of it, why it is very important to leverage my company in particular to receive the best possible IUL contract out there. Now, with any sort of life insurance policy, any sort of permanent policy, you have money that goes in, and kind of look at this little ugly egg shape as your life insurance policy, and it goes into two different factors, right? You have one portion of your money goes into something known as the cost of insurance, and the other portion goes into something known as your cash value. Now, let me just focus in on the cost of insurance, and then I'll kind of go into, to give you the generalization of everything and then delve into the specifics. Now, the cost of insurance is just nothing more than deemed your insurance expenses, okay? It's deemed as your insurance expenses. And this is something that always needs to be paid because it keeps the policy in force. If there's no cost of insurance, then the policy doesn't exist. Because essentially what's happening is the payments, however much this cost of insurance is determined by the death benefit. With all sorts of life insurance, you have a death benefit that will get paid out to your beneficiaries in a tax-free manner. So it's very basic, very easy to understand. Now, typical permanent life insurance policies have the cost of insurance that increases every single year. Because if you think about it as a general concept, the chance of you passing away every single year you get older increases more and more. So that's why essentially, typically, the cost of insurance should always increase in a permanent life insurance policy. Now, realize that I said the word typically because the contracts that I have proprietary relationships with have a decreasing cost of insurance and essentially a non-existent cost of insurance in years where you're looking to really utilize your policy and utilize it for a sort of retirement aspect. Now, I want to stop, and I hope that made perfect sense regarding the cost of insurance. It's just essentially the expenses that need to be paid every year. And I want to stop, and I want to talk about and concentrate on this little side known as the cash value. Now, like I mentioned, your premium dollars, it goes into the cost of insurance and it goes into the cash value. So I want you to think of this cash value as a sort of savings account. After the cost of insurance is paid, the remaining amount is placed into the cash value. What makes a good cash value growth regarding this specific company, because all the companies offer these types of permanent policies, but what makes good cash value growth versus a bad cash value growth is the percentage rate that is credited on top of the premiums that are placed into that cash value. So remember, one side is going to the cost of insurance, everything remaining is going into cash value. So that cash value also is sitting into an account that gets credited on an annual basis. So what distinguishes a good company from a bad company is what would give you the best chance for a very favorable percentage rate increase on that cash value side. So that's why individuals always like to, or life insurance specialists that really hone in on the cash value, they want to make sure that this cash value amount is maximized to its fullest. And the pros regarding the IUL contracts has to do with the cash value and how favorable that cash value could grow. And you could leverage this cash value in a couple different ways. The first is this cash value grows, so this is the amount of money that's placed in there plus the percentage rate that is gained. It grows on a tax favorable basis, meaning anytime that you have an interest credit in that account, you will be seeing a gain within that account, but you're not going to be receiving a 1099 like majority of mutual funds out there, or like a bank CD or a savings account. Every year that you see a gain into that account, you get a 1099 where you have to pay taxes on this. So this is going to grow very tax favorable. Kind of think about it in the bucket with a little shell over it. You're going to receive contributions into any time that sort of percentage rate gains is going to receive gains into your account, but you're not going to have taxes pulled out on an annual basis. Now, the larger that this bucket grows, and the larger that you extend this bucket out, and when you're ready to essentially take from this bucket, there's a way that you could take out completely tax-free, 100% tax-free. But you need to be very, very careful with how this works. And this is why I say, without a doubt, definitely give our company a call, because we specialize in these types of plans and show you how to pull out the money of a cash value life insurance policy and an IUL policy in a tax-free manner. Now understand, with traditional types of retirement plans and traditional types of retirement accounts, you have something known as a 59.5 rule, meaning like a 401k account or an IRA account. Whenever the bucket grows, and you cannot touch that money, you cannot touch this bucket until after age 59.5. Well, with this sort of plan, there is no 59.5 rule, thus allowing you to retire before the age of 59.5. You could be younger and retire. You could utilize this bucket of money and not have to worry about penalties and not have to worry about full taxation like you do with 401k and IRA accounts. So it's very, very powerful. And then on top of it, there's the L in the IUL stands for life insurance. So this means that there's a death benefit associated with it, and it's a tax-free death benefit at that. So let me just pull up a new screen. So if I reiterate how the policy works, once again, we understand that money goes into this insurance policy. You have a cost of insurance side, and you have a cash value side. Now, one of the things that we're trying to focus in on is the cash value and the percentage. And right now you're probably asking, well, how the heck does that percentage growth go in there? I understand with the cash value, it's the premium dollars that are placed into it, remaining from the cost of insurance, and a certain percentage rate equals what your bucket of money is, what your account value is in that cash value account. Now, this is where everything gets exciting regarding the IUL, because this is where we focus it on the I, index. And what happens is it utilizes indexing strategies. Now, with any sort of investments, if you look at investments, if you look at financial advisors, wealth accumulation specialists, whatever that is, they say throw your money in the market. Because typically, from the inception of time through the stock market has always shown increases. But unfortunately, as the market can go up, in 2008, individuals realized that the market could go down just as fast, and the average portfolio experienced a 57% loss in the average portfolio, account. So what these index policies do is it utilizes an indexing strategy where it allows your account to participate in market performance, have an increase whenever the market performance does well, but not have any downward market loss. So in years that index that you choose, and typically it's the S&P 500, 90% of the time it's the S&P 500, which is just a benchmark index. Anytime the S&P 500 goes up, you're going to receive a credit into your account. Anytime the S&P 500 goes down, like it did in almost 57% in 2008, you'll receive a credit of 0% to your account. So you're receiving very favorable growth rates and very consistent growth rates on your cash value account. So it's the premium dollars, and the percentage rate that it's growing by is allowing it to have something known as the compound effect. Albert Einstein deemed the most powerful thing in the world is the power of compound interest. Now, we want that power of compound interest to always be increasing and to never work in a negative effect, because compound interest could work very negatively, especially when it comes time for taxes, especially when it comes time for downward market losses. And that is essentially how accounts completely get, and also when you're trying to pull money from those accounts, income from those accounts, those are three major areas that compound interest can negatively affect your account. So we only want to focus in on the positives. We only want to participate in upward market movements. We want to minimize the fees. We want to reduce and eliminate ethically and legally reduce and eliminate the taxes. So what do we do differently at a Fosse Financial Group that different advisors and different life insurance specialists, that people that try to set up these policies, do? And we have been utilizing years and years of research, and we analyze the best possible contracts out there where we could, rather than have a structure of a permanent life insurance policy, you say, listen, I want to only leverage the cash value, and I want to leverage this cash value growth. We have proprietary relationships with some of the top companies that are designed for max cash value accumulation. So essentially, if you're looking at your egg, that same type of egg, the cost of insurance is over here and your cash value is over here. So remember, the cash value, this gives you that tax favorable growth. This gives you that tax-free income that you could pull. This gives you the option of the no 59.5 rule. And essentially, there's still a cost of insurance there, so there's still a death benefit, a tax-free death benefit that will get paid out, God forbid, whenever you pass away. So we're trying to focus in on this cash value and really focus in on ethically and legally trying to really hone in on that tax-free income at that later date and make sure that our accounts are growing and you're leveraging your dollars. You're leveraging the smallest dollars possible to produce the maximum result. And now I'm going to talk about a personal story, because this is something that I want you guys to understand, that this is what I do for my own. This is what I have set up for me and my wife's plans. Okay, this is what we set up for our retirement accounts. She's currently a teacher, and she has a 403b through work. So, and what happens with every other majority of the person that she works with, they contribute money into a 403b account, 403b account, 403b account. 403b is the same exact thing as a 401k, except for this is set up for state-run regulation, state-run plans. So because she's a teacher, she works for the state, they're offered a 403b. It's set up the same exact way as a 401k account, except for 401k accounts are set up for private institutions. So what happens is she was placing money into the 403b account every single month, every single year, hoping, and this 403b account was tied to mutual funds. So as she's placing money into it, she's hoping that the mutual funds will do well. And obviously I'm the one who monitors her fund performance. Now, right after I found the correct companies, and remember, I only utilize 2 to 3 different types of companies. Works absolutely perfect for our age, and so I could have a policy, and I actually deemed the IUL policy, I deemed it in-house as an accumulation insurance contract. So what we did was we could utilize the $200 that she was placing a month into her 403b account. We're not placing that in there anymore, and we're placing it into this overfunded IUL policy, or my company is deemed as an accumulation insurance contract. And essentially what this does is the money goes in, it has very low cost of insurance and very high cash value. The cash value grows off of that indexing strategy. So the longer that she places her money into this plan, the longer that this tax favorable growth keeps growing, and the greater the chance that she allows the market to increase and show a larger increase in double-digit figures into her cash value growth. Now, she does not have to be age 59.5, which works with typical 403b policies. You have to wait till age 59.5 to retire and to start taking money from this account. She could start pulling money from this account at any time that she's in her 40s, any time that she's in her 50s, and essentially receive it on a tax-free basis. Now myself, I've set up the same exact plan. Now rather than $200, I place $2,000 a month into this type of plan. And all that does is it maximizes my benefit that much more. So with my plan, I place $2,000 every single month. I have it, and this is tied exactly to the IUL type policy. It's a life insurance policy, but there's a company that's set up where they try to reduce this cost of insurance as minimal as possible and maximize the cash value. So her funds are going in $200 a month. My funds are going in $2,000 a month. It's completely safe. I I participate whenever the market goes up. My cash values do not decrease whenever the market goes down. I just receive a credit rate of 0%, and I don't have to wait till I'm in my 60s to properly retire. I've always wanted to retire young. That was what and this is one of the things that I want to explain and want to educate individuals, is you could do the same exact thing by leveraging your dollars, and you do it on a safe, consistent basis. You could participate in that power of compound interest. You could participate in those upward market movements without the downward market loss. I still have death benefit coverage because there is a cost of insurance in there, but by the time I have these policies structured that when I start taking income from this account, the cost of insurance is either reduced or is at $0 every single year. And there was these proprietary relationships that have this cost of insurance down to a science, and they have these proven patents that are set up and designed for these contracts because they are set up for the individuals that only want to maximize their cash value policies. So once again, this is something I'm very, very excited about. I'm placing in, this is everything that I have that I've set up on a retirement plan for myself and a retirement plan set up for my family with my wife as well. And it's because I believe so heavily in it, and I've already seen my plans do such wonderful things. And I know I'm going to have that peace of mind that if I want to start taking retirement income, I could take it in as little as 10 years. So please, give us a call. We could educate you a little bit further. We could see exactly if this might be a plan for you. We deem it in-house as an accumulation insurance contract, but essentially what this is an overfunded IUL policy, and we navigate through hundreds of the top contracts, making sure that your cost of insurance is as small as possible so that your cash value could be maxed out as much as possible. So, please review this. Please take notes. Give our 1-800 number a call. We implemented 24/7 customer service where you could deal specifically with an accumulation insurance contract specialist, and and this is a way that it's a different take on how to receive tax-free income during retirement, how to receive tax-favorable growth, and make sure that you're not susceptible to that 59.5 rule. So it's some very powerful things, and this is something that I do set up with my own monies, and this is something that I set up with my own family on our sort of retirement plans, in-house. So I could educate you. One of my representatives could educate you on this. We could send you literature pieces, create personalized videos for you, and just kind of go from there. So hope you enjoyed this, guys, and let me know any questions, comments that you may have. Thanks.